From the impact of the new federal budget to trade tensions and a Bank of Canada which may be on hold for all of 2026, there are plenty of big questions facing our economy. Joining us now with some of the answers is Derek Burlton, VP and Deputy Chief Economist with TD Bank Group. Derek, always great to have you on the program. Welcome back.
Thank you, Greg.
So your shop, TD Economics, has put out a new report trying to answer some of these big questions facing Canada right now. Let's start with the federal budget. Now that it's law, will this start to transform the Canadian economy?
Yeah, we're going to have to wait and see. Rome wasn't built in a day, and Canada's facing huge challenges. And I'll start off with things I liked about the budget, a number of things. I like the fact it was focused on investment and crystallizing about $500 billion of private investment over the next 5 years. They set some ambitious targets. That's all great. A lot of measures within that budget, I think, will be a good first step to moving the goalposts towards those objectives, the public infrastructure investment, some of the tax initiatives, full expensing of capital cost, and a broadening of that measure that was during the Trudeau government. They've extended that and expanded it. And so those are good. Now, is it transformational? I'm going to hold my breath a bit on that one. I think, again, this is one budget. They're going to have other opportunities. I would like to see deeper rethinks of the corporate tax system. There's a lot of regulatory. I mean, when you think of Canada, just the steady growth in regulations and the costs, so much work to do on that front. And I think they're going to have to be a bit bolder. For example, program spending review. I think they could go deeper on that than they did. So we'll have to wait and see. I think we're going to keep pushing them on being a bit bolder, on going further on some of these transformational issues. But we are moving part of the way there, and we're going to be watching to see some of the near-term impacts.
I can't think of a budget in recent years that have had this much expectation heading into it, based, of course, off the fact that our trade relationship with the United States got pretty tense and didn't really get much better as we headed through this. So this budget was supposed to be the thing that will chart a new course, right? What is that trade relationship like right now? Next year, of course, we're going to have NAFTA, CUSMA, USMCA, whatever you want to call it, renegotiations. What does the relationship look like for you?
Well, right now, not much seems to be going on. I know the talks are always ongoing, but what we did do, because we don't have a lot of sense, we don't have a lot of direction right now, is we just assume the status quo in our forecast through 26, 27 in terms of our current thinking. That is still tariffs. Still that USMCA exemption that's cushioning a lot of Canadian exports from duties. And we'll see. I mean, I'm comfortable with that view. Now, the big questions remain. Are we going to see a bilateral deal in the near term, which would offer some relief to sectors that have been hit like steel and aluminum? I think there's a decent chance, but again, nothing's imminent there. And then going beyond that, USMCA review. When we look around the world, the kind of deals the U.S. has been signing gives us a bit of a taste. Some base tariff, some relief, some quotas, some commitments from Canada to invest in the United States, things that Mark Carney has flagged in some of his recent discussions about investing up to $1 trillion in the U.S. over 5 years. So we'll have to wait and see. We don't make any heroic assumptions in terms of our current view as we sort through some of these questions. But I think I am more confident we're not going to see some of the disaster scenarios play out, just given the fact we've come this far without the full negative effects of tariffs that were initially feared.
I could definitely use a few less disaster scenarios heading into 2026, so I like the sound of that. Another big change in terms of the Canadian economy and our policy has been immigration. Obviously, a big part of the economic story of the last several years has been booming immigration. Those numbers have been peeled back. What kind of impact does that have?
Well, that was a shock we were talking about a year ago before Trump took office, and the impacts of going from 3% population growth effectively down to zero and what kind of impact that could have on the economy. We are starting to see some effects as that growth rate has slowed dramatically and will continue to slow well into 2026, taking some pressure off social infrastructure, easing some of the conditions in rental markets. We're seeing markets like Toronto, Vancouver that tend to have higher exposure to new international migrants, students and the like are seeing some of the greatest easing show up, and I expect we're going to continue to see this. One thing, it's a bit of a silver lining, and I think 2026 should show this firsthand, is that the unemployment rate has been rising gradually, albeit it's flattened at around 7% more recently, but The big growth in immigration labor force was really being the driver of that higher unemployment rate. Just the fact a lot of migrants weren't able to find jobs as we move into the early part of this year. With that channel being choked off, I do see it capping the unemployment rate at just over 7%. Employment's not going to grow very much, but nor will the labor force. And we should start to see a pivot down to the unemployment rate. So that's actually a silver lining to some of the negative impacts on growth and labor force and the overall market.
Now, this is our backdrop. We have a Bank of Canada that's indicated pretty firmly that it's on hold for now. Of course, then the question becomes, what does for now mean? Are they on hold for all of 2026? What could make them move in 2026?
Well, our baseline assumption is, no further moves. We're kind of at the low end of their neutral range. And I think barring a recession, which would certainly provoke more rate cuts, I think they're just going to be moving sideways. And right now they're looking at a rate of underlying inflation in Canada about 2.5%. It's about 0.5 too rich for where they'd like to see it. The economy's still growing, albeit modestly. And I think they're very comfortable. And if you don't see any big deviation from this, and we don't see inflation going down to 1.5 or anything, I think they're just going to sit tight at that rate of 2.25. Yields are going to be pretty flat as well when you look further up the yield curve. So I think Canadians have to prepare for a very stable rate environment. Could be worse. We've seen rates higher, but if you're looking for rates to come down a lot further, 5-year yields and the like, you're just probably not going to see that.
So if we're not banking on, obviously, there's been relief from the Bank of Canada that they've done their part right now. We actually have someone watching our conversation in real time asking about productivity growth. You and I have talked about this a lot in Canada. We are concerned that we just didn't have it compared to other advanced economies. So this person basically asking, what structural reforms, investments do you see as most critical to actually get our productivity growing?
I think a lot of what was in the budget will help. And again, we're just going to hold out and watch and wait. We're not going to make any heroic assumptions that investing in ports and rail and transportation infrastructure is going to lead to some big productivity boom. Over time, I do anticipate some of that to show through. I think one of the bigger areas of uncertainty is AI. And something we didn't see a lot of in the budget on AI, and that's something I'd like to see more of. We're going to be prodding, again, the federal government to focus more on an AI strategy. But I do know that business sector is rolling out AI, and some of those benefits, I think, will flow through. And, we're looking at 1.5% growth in Canada when you've got pretty much no growth in the labor force. You really are relying on productivity to step up a bit to achieve that. So we are making some assumptions, but it's still an area of big upside opportunity for Canada. No productivity boom on the horizon.
Someone had to take away one big thought from our conversation here about 2026, the Canadian economy. What should it be?
I think expecting more of the same in terms of growth, stable rates as we've talked about. I think the more interesting aspects are going to be what plays out in the U.S. and globally. There's a lot of uncertainty with Trump now turning his attention to dealing with affordability. Could be good news for Canada on a tariff perspective as they try and limit some of the import cost increases. But it could change the dynamic of the U.S. economy as well. Some of their ideas on $2,000 checks to American households and the like to help them over the hump. So I think for me, just like this year, a lot of the focus is going to be what happens south of the border in terms of how some of these issues play out.